Mayor Crate. Sitting in for our city treasurer is the deputy treasurer, Tracy Laniger. Also, I have our deputy clerk, we have our city attorney, and our chief of staff, and our guest. So welcome to this evening's special meeting study session. Today's date is Monday, March 24th, 2025. And the purpose of this special meeting is to discuss the quarterly investment report. And at this time, we will have roll call. Councilwoman Abdo.
Here.
Councilman Barden.
Here.
Councilman Kraut.
Here.
Councilman Jones.
Here.
Councilwoman Roscoe.
Here.
Councilwoman Talley.
Here.
And Mr. Wadsworth, we ask if he can be excused
Excused.
this evening. So noted. Mr. Chair, Council, we have a quorum.
Thank you.
Tonight's special meeting agenda is as follows. Number 1, roll call. 2, agenda. 3, discussion, quarterly investment report. 4, public comment. Number 5, adjournment. And a motion would be in order to accept the special meeting agenda as presented.
So moved to accept the special meeting agenda as presented.
It's been motioned by Ms. Talley, supported by Ms. Abdo, for study session agenda as presented. Ms. Talley?
Yes.
Ms. Abdo?
Yes.
Ms. Roscoe?
Yes.
Mr. Jones?
Yes.
Mr. Kraut?
Yes.
Chair votes yes, motion approved.
Thank you. Mr. Chair and Council, again, tonight's meeting is to discuss the quarterly investment report. Presenting tonight's presentation is the Senior Director of PFM Assessment Management. We have Ms. Lepley Gray. Did I pronounce that correct? All right. You have the floor, ma'am.
If it's red, is it on? Or
Yes,
off?
it's on.
Oh, it's
Yes.
on. Okay, great. Can you all hear me okay? Okay, fantastic. Good evening. Nice to see all of you. Hope you're all doing well. You've seen me, some of you have seen me a few times now. So as I've always said, and as I will continue to say, please feel free to interrupt me as I'm talking if you have any questions or if there's anything specific you'd like me to focus on more. I'm happy to do that. So the way we have the report structured is essentially the market update. Again, this is a little bit old because it's from the fourth quarter, so ended December 31st. I will try to keep it a little bit more current for you, and then we'll go into the actual portfolio and what's going on with the city's actual funds. So to start out, I'm going to start on this page. I think it's important to talk about the Fed, not to bore everyone to tears, but when we're thinking about what's going on with current interest rates and where we're seeing rates go, we expect that we're going to be in this wait and see kind of period of time. Because of the fact that we have two main factors going on. The Fed has a dual mandate of keeping prices as stable as possible through not having inflation be too hot or too cold. Well, we've seen inflation be quite hot, as you know, with egg prices and all those other things that have been really high recently. It got up to 9%, over 9% in June of 2022, but as you can see from the left-hand side, inflation has come down. However, it has not come down to where the Fed would like it to be, which is 2%. So it's been kind of moving sideways, bouncing up and down around that 3%, 2.8% level for quite some time. Why does this matter? Because the Fed raised rates and yields, therefore, and investments we've seen yields go up quite a bit in order to fight that inflation. So if they haven't gotten inflation completely under control yet, we're going to probably see a period of them keeping those interest rates higher for longer. So again, wait and see kind of mode. On the right-hand side, you can see the unemployment rate. This is the other part of the Fed's dual mandate, to keep jobs as plentiful as possible, to keep full employment. For years, people defined full employment as about 5%. We're currently standing at, this is saying 4.2, but we're actually down to 4.1% currently with the unemployment rate. But that annotation, I think, is really important on there, which says that over the past 25 years, the average unemployment rate has been about 5.7%. So if you think about that being the average and us being at 4.1%, we're in a really good spot, all things considered, with jobs. Now, the information I have here, the information I just mentioned, does not include some of the job cuts that we've seen as part of DOGE and some other things that have been going on recently. However, that is a very small portion. Federal workers are a very small portion of the overall job and workforce here in the U.S. So it's unlikely that we're going to see a huge spike up because of those changes that we have recently seen by the federal government and by the president's administration. However, inflation, as I mentioned on the previous page, if the next page goes, is really of prime, in prime focus, and that's because of the fact that we're expecting to see a bevy of tariffs. We've seen some already. We're expecting to see more come into focus and really play a big part in terms of prices of goods and services here in the U.S. So if you look at the right-hand or the left-hand side here, you're seeing a bunch of the different things that we were concerned about going into the first quarter as a result of the fact that the new administration was coming in. Some of these are positive for the economy. Taxes, lower taxes could mean a higher deficit, but at the same time, it could be good for growth. You can see tariffs here. Tariffs are viewed as being inflationary. And so we're expecting that they are going to continue to buoy prices up higher than they would otherwise be. So we've heard about the aluminum tariffs, the steel tariffs. We've seen tariffs potentially going into effect, some going into effect on China, some on Canada and Mexico. A lot of things going on there, and kind of day to day, we're getting different pieces of information. So again, tariffs especially have been a really big deal. And when we think about what the Fed has said recently during its meeting last week, they have really been focused on this as well. And we'll get to what their projections are for the remainder of the year, but something to really focus on. Two other factors are immigration and regulation. Immigration, if we are in a position where we have a lot of people deported or leaving the country that would otherwise perform certain types of jobs, are Americans going to perform those jobs at the same wages as the immigrants have been previously, right? There's some questions there. And then regulation. Generally, President Trump's administration and his views on regulation are for easing regulation, and that is viewed as being positive for economic growth in general. One of the things I did want to mention on this page, and we don't have to get too deep into the graphs here, but on the right-hand side, this is basically showing us that people have been front-running the tariffs, meaning that people are purchasing and have been purchasing products, goods, services, all of those things ahead of tariffs going into place because they're concerned about those prices going higher. That's also meant that what we've seen is that we're importing way more than we typically would import, even though we import a lot into the US, and that has been negative for the trade deficit as well. So what we're seeing is a trade imbalance that's much more out of balance than it typically is as well. So just keep that in your mind as we get into some of the other slides and talk about GDP, which is actually on this slide here. So you may have heard about recessions and people talking about stagflation. I don't know if anyone has heard about any concerns about that recently. But essentially what we're expecting here, if you look at some of the prognosticators out there, is not for a recession in the next 6-12 months. However, if you look at the past few quarters, you can see 3%, 3.1%. We saw 2.3% come in for the fourth quarter. This first quarter, which is not yet over, the actual estimate there is actually negative, about 1.5% right now, 1.6%. So does that mean that we're going to see a recession? No. A recession is defined as 2 quarters of negative growth. It also needs to be agreed upon by a certain group of people that it is in fact a recession. So 1 quarter of negative growth potentially because of that trade imbalance that I just mentioned, people importing a lot more goods ahead of potential tariffs, would mean that we would see negative growth potentially for this first quarter. That remains to be seen. We haven't finished the quarter yet, but that's what's expected. And then as we go forward from there, you can see these are the estimates as of about January 15th or so. So these are old and stale. What we've seen since then is that the rest of these estimates have come down as well, meaning that we're expecting that economic growth is going to be slower than was originally anticipated. I'm going to skip over this page and go to this one, the Fed dot plot. Now, I mentioned that the Fed has met last week and had their meeting where they put together these projections, exactly what's on the screen here. This is from the previous meeting, so I'm going to bring it up to date. If you look at that dark blue line, that is where Fed officials thought that interest rates might go over the next few years, as of December. So when they put these projections together in December, this is what they were thinking. If you look at 2025, you see all the way at the bottom, it says 2 cuts. Meaning that we would see 2 interest rate cuts during 2025. Going into 2027, or 2026, excuse me, 2 more cuts, and then one more cut in 27 and longer-term rate of 3%. Think about where interest rates have been over the past 15 years. In your own lives, in your savings accounts and things of that nature, have you been able to get very much money or interest on those balances that you have? Probably not, right? We've seen interest rates near zero for a very long period of time. The reason I'm bringing this up is because this 3% long-term target, or this 3% long-term projection that the Fed has, is quite a bit higher than 0%. And basically means that we're expecting that over the long term, we're gonna see overnight rates, so things like savings and liquidity vehicles, local government investment pools, money market funds, at around 3% rather than going down to 0%. So that's the expectation, that 0% was not normal, that was a period in time, but that we'll be going into a position where for the longer term will be much higher than that. To bring this closer to today, that dark blue line is actually the exact same as it was in December. So that line is as of December. If I were to plot today's line, it would be exactly the same, meaning that the Fed, again, is thinking 2 cuts for this year. So that would bring interest rates down by about 50 basis points or 0.5%. So interest rates are expected to stay higher for longer. And again, this is the wait and see theme that I talked about a few minutes ago. I'll tie that back into why it matters for your portfolio in a few minutes when we get further along. Last part of this section that I wanted to speak about, but of course I'm glad to look at any of the other slides or pages if you had questions. This page shows where the yield curve was as of the end of September, that's the dotted blue line, versus the solid blue line, which is where it was as of 12/31. And you can see it's much higher basically across the board. So where we're investing is in that 0 to 5 year space. So think about it as really being on the left-hand side of the page. That's where we're investing your funds. You can see that interest rates moved up pretty significantly over the quarter, right? Going from that dotted line to that solid line. What that means is when rates go up with bonds, which is what we're invested in, we actually see market values fall. So we saw market values fall to a certain extent over the quarter. That being said, all things considered, it was pretty mild, and we're in a situation where interest rates are so high right now that you're getting a lot of income from all of the different bonds that you're receiving, or that you're purchased and are in your portfolio, and that's been buoying your overall return. Any questions on any of that before I move on to the portfolio section?
Yes, to the chair.
Yes.
And we'll probably get to it. I'm just curious overall with everything going on with tariffs, immigration regulation, how that's going to totally affect our portfolio.
Yeah, great question. So I think the main focus is, again, as I said about tariffs, is whether or not they're going to be inflationary and how inflationary.
Okay.
If we see them be inflationary and keep prices high, that means that the Fed is going to keep interest rates high.
Okay.
What that means for your portfolio is that you're likely going to see these yields continue to be higher, which is a good thing, right? Mm-hmm. It means that you're going to continue to get 4.5% on these different types of securities in your portfolio.
But the downside?
The downside is that we're going to see an erosion of those prices, right? Prices are going to continue to be expensive, and so you're going to see an erosion of that 4.5%. So when you look at it on a real basis, you take inflation out, it might not be that 4.5%, right? It might be closer to 2%.
Okay.
Yeah.
It's still net positively, you say?
Yes, net positive. We're not in a position where, like we were in 2022 when it was 9% inflation. We're not there, right? We're down to 2.7, 2.8%. So it's much more manageable, but it is something that we need to continue to think about.
Okay, thank you.
Yeah, absolutely.
Any other questions from council? Okay,
Okay,
continue.
great. So I'm going to skip over a few of these pages here and get into the portfolio itself. So here we have the consolidated summary. This is on page 25. You can see that when we're looking at this, we've got $270,000 or so in GovMIC. That is the local government investment pool that PFMAM manages here in the state. And then the rest of this is the managed account. That's about $36 million in total at the end of December. When you look at the sector allocation in the top right-hand side, you can see it's quite diversified across the board, but that big gray section is Treasury securities. Basically, based on code here, Public Act 20 here in the state of Michigan, you have to invest in very highly rated, highly liquid, safe securities. And so when you look at this, you'll notice that almost every single thing on this list is a governmental or a quasi-governmental security. The only thing that's not is commercial paper. Commercial paper is very short-term corporate debt. But the only thing that you can purchase here is extremely high quality, very short-term, highly rated, commercial paper. So again, all of those things together mean that the overall portfolio is highly liquid, highly safe, and of good credit quality as well.
Through the chair,
Yes.
is it safe?
I can't guarantee anything. I'm not allowed to guarantee anything. My compliance department would come in here and yell at me. However, I can tell you from the overall credit rating, the overall credit rating of the portfolio is a AA plus on average.
Okay.
AA plus is basically as high as it gets, close to as high as it gets. You could say, okay, well, AAA is actually the highest, and that's true. However, the U.S. government was downgraded in 2011 to AA plus. So when you think about the actual quality based on Moody's, S&P, those types of rating agencies, that's what they would rate your portfolio.
When is it, how often do they get rated?
How often are the rating agencies looking at the ratings?
Yeah, I mean, you said we got downgraded to a AA?
The U.S. government.
Yeah, how often is that
They
rated?
could do that at any time if
Okay.
they wanted to, technically.
Okay.
So, you know, there's not a specific, I don't know if there's a specific schedule at which they look at these things on a regular basis, but I know they could at any point
Okay.
downgrade it. Now, the reason that they downgraded in 2011 was because the deficit has continued to grow, and they basically wanted to say, hey, it's great that we're basically considered the risk-free or the safest investment in the world. However, at the same time, we need to show that there is some danger, potentially, with the deficit being as high as it is. So that's why they downgraded it
Okay.
in 2011.
Thank you.
Sure. Here we have a picture of all of the different funds. These are not just what's managed by PFM Asset Management, but also what's managed by Robertson Capital, as well as some of the other funds that are in Michigan Class, which is another local government investment pool. So about 88, if my eyes work, 88 million as of the end of December. Here we're showing versus September where you were, and we have seen some outflows. So you see going from about 110 million to 88 million. But if you look at this page, you'll see year over year, you're up. So going from about 85 million to about 88.5 million on a year over year basis from December to December. So right in line with seasonal changes and what we would typically see. This breaks down to your point. You can see the different types of investments and what the credit quality is of all of those types of investments across the board. So again, none of them are rated below AA. If you look at that commercial paper, you can see that's A1. There's also some A3s. That is actually the highest or one of the highest classifications you can have in short-term funds. So it's considered essentially somewhat equivalent to a AA or AAA. So getting into our account specifically, you've already seen the sector allocation, and you've seen some of this information already. But I think I want to point out on the bottom right-hand corner, the duration distribution. What's important to think about here is that if you've been around the block here for a little while, you know that we actually expanded our investments going from a 0 to 3 account to a 0 to 5 account last spring. What that meant was we were able to lock in some of the high yields that were going on at that time in that 3 to 5 year space. And so you'll see in the portfolio currently we have quite a bit in that 3 to 5 year space, quite a bit in that 3 to 4 year space really, and not as much in the 4 to 5 year space. But versus the benchmark, which is in gray, you can see we have some different tactical allocations across the curve. So we have a little bit more in the 0 to 1 year bucket, and again, if you look further out the curve, a little bit more in that 3 to 4 year bucket because we believe that those are where we're seeing the most value right now. The other reason for the, overweighting in the 0 to 1 year bucket is because that's where commercial paper is, that yellow section. That's the only place we can buy that credit. So when we're looking at buying that, that typically has a lot more yield benefit and a lot more incremental value than what we can get in treasuries, and that's why we're seeing that as well. This page shows the evolution of the portfolio over time. I would say the biggest thing to talk about is really going from March of 24, which is on the left-hand side of the page, to December of 24, that brown section was the local government investment pool, overnight funds. We made a conscious decision to specifically take those and put them out the curve, as I mentioned, in that 3 to 5 year space to capture those yields. And so that's what we're seeing here. We're seeing that section kind of move away and go into different types of investment securities. And then the fun stuff here, page 34, this is showing portfolio performance. I mentioned with interest rates having gone up over the quarter, if you remember those two lines, the dotted line to the solid line, interest rates moved up, market values fell. So you can see for this past quarter, if you look down at total return, the portfolio had a total return of negative 0.35%, so negative market value return. However, that's versus the benchmark of about negative 37 basis points, so we outperformed slightly. But if you look at the top, you can see the interest earned was about $300,000. So again, we're producing, the portfolio itself is producing quite a bit of value for you over time. If we look back over the past year, you'll see 437 versus a 417. So, you know, a 1 year return of 4.37% is great. You earned 1.4 million in total earnings during that period of time as well. And then if you look back over a longer period of time, you can see because of the fact that we saw interest rates be so low for so long, that the portfolio return is much lower at a 1.66 versus a 1.51 of the benchmark, so outperforming the benchmark by about 16 basis points. So over the life of this portfolio, over the past 10 years, you can see about $4 million has been earned. And about $1.5 million of that just in the last year alone, just because of where interest rates have been. It's nice to talk about percentages, but I think it's good to also put that in dollar terms. So if we look at this page, this shows you accrual basis earnings. And again, for the past 3 months, you see that interest earned around $300,000, but you also see realized gains, losses, change in amortized costs. So total is about $400,000 just for the past quarter. And from the chart at the top, you can see it's kind of going on this trajectory that's much higher than it had been previously. Reason being is that we've continued to see higher interest rates than we had previously as well.
Okay.
So if you look at 2015, all the way on the left
Ms.
side.
Talley.
Yes.
Yeah, really quick, when we say 3 months, 1 year, 3 year, 5 year, 10 year, those in the previous,
Yes.
okay, gotcha, okay.
Yep, exactly. Over the past 1 year.
Not
3 year, 5
projected.
year. No, not
Okay,
projections, no.
okay.
No, the actual earnings that you've had in the portfolio.
Okay.
Mhm. So the only thing I was going to mention is that on the left-hand side of this page, you can see very little interest earnings for a long period of time. And again, that's because interest rates were near zero. And then as interest rates have gone up and down, but then up again recently, you're seeing that take off. So that's where we are right now. Again, 4.2 million in the last 10 years, 400,000 of that, about a tenth of that just in the past 3 months. So the rest of this is a lot of fun nighttime reading. If you want to fall asleep later, feel free to look at that. I'm not going to go through all of it, but if you have any questions on anything else, I'm happy to answer those.
Any other questions from council?
Yeah, I have a question.
Ms. Talley?
So, as I was asking earlier about, there's just so much going on in our world right now. It's a lot. And so, do y'all kind of do projections of what the next quarter might look like? Do y'all have those discussions? I would just be curious of what those are.
Yeah, absolutely. So when it comes to projections, it depends on what you're talking about. We do projections for sure. We do projections on multiple market factors and also economic factors. And so when we're looking at what we're expecting for this quarter and next quarter in terms of the economy, what we're expecting is some sort of negative growth, so contraction for this next quarter. Then when we go further from there, again, it's hard to say because there's been so much back and forth and up and down, and you know, the news cycle every day is a little bit different. So again, when we think about that, it's you know, the Fed has said it, and I'm going to say it again, it's wait and see, unfortunately.
Okay.
That being said, the way we have your portfolio positioned right now is essentially neutral to the benchmark. And the reason that that's important is because we don't have conviction that interest rates are going to go up significantly or down significantly. If we did, we would be positioning you a little bit shorter or a little bit longer of the benchmark. But because we're in a position, just like everybody else, we're not exactly sure what's going to happen just
Right.
yet because the other shoe hasn't dropped yet, exactly. So because of that, we are continuing to keep you neutral to the benchmark.
Yes.
Thank you.
Ms. Abdo?
Yes, our current administration, our president has aggressively attacked other countries. He's come out publicly and said more than once that he's predicting World War III. Has this been discussed as what this would do to us?
Yes, so that's a great question, and I appreciate you bringing that up. I would say, well, in general, we have a very robust investment process. If there's an exogenous event like World War III, the safest place to be, honestly, will continue to be in governmental securities. And luckily, you are invested almost entirely in governmental securities. That is not something that is predicted by the different creditors out there, the different, like I said, prognosticators earlier. That's not something that would be a very slight chance. I'm not saying it's not gonna happen, because I don't know what's going to happen. But because of that, what you're seeing is risk is not being priced into the market. Meaning, if people were super concerned that there was going to be something really awful like that to happen, you would see spreads on credit instruments like commercial paper, which was in yellow earlier, widen out significantly because people will be worried about holding those types of securities and only want to hold on to safe haven assets like treasuries. Because we're not seeing that, I don't think that's being priced into the market at this point.
All right, thank you.
Sure.
Thank you. Any other questions, comments? None?
Thank you.
Thank you.
Number 4 is public comment, and this is the portion of the agenda that's open to the public for comments concerning tonight's subject matter, the quarterly investment report. If you'd like to have comments, raise your hand, and after being acknowledged by the chairperson, approach the podium, state your name, and please note that you will have 3 minutes to speak.
Any comments from the audience? If there's no comments from the audience, Madam Clerk, will close it out.
Thank you. Takes us to number 5, adjournment, and the time is 7:16.
So moved to adjourn.
Support.
Been motioned by Ms. Roscoe, supported by Ms. Abdo for adjournment. Ms. Roscoe?
Yes.
Ms. Abdo?
Yes.
Ms. Talley?
Yes.
Mr. Jones?
Yes.
Mr. Kraut?
Yes.
Chair votes yes, we are adjourned.